Forests. The story of humanity has been tied to them. They provide us with clean air and water, places to recreate, reflect, and restore, and essential products that shape our health, our prosperity, our way of life. When society and force are in balance, each can flourish. And when they are not, both suffer. Today, major forces are shifting this balance. An ever-growing population, a changing climate, catastrophic wildfire. It is clearer than ever that our fate is tied to the fate of our forests. Innovations in science, business, and technology provide hope. New methods in growing, harvesting, and replanting trees. Construction that is kinder to the environment and to society. Policies that allow healthy wildfire to return to the landscape. Investment in the full benefits of tree. However, awareness and innovation alone are not enough. Society must have the will to act. World Forestry Center is building that will. Join us in expanding our community, empowering new voices, and driving the actions that create healthier forests and, in turn, a healthier society.
Hello, I'm Joe Fiera, Executive Director of World Forestry Center, and welcome to the sixth and final episode of Who Owned the Forest, the Series 2020. This morning, we're discussing ESG investing, climate risk and reward, and fiduciary challenges in the decades ahead with Bob Saul from Fiera Comox and Spencer Meyer of the Highstead Foundation. We are pleased to present episode 6 of Who Owned the Forest, the Series 2020.
Thank you all who have subscribed to this virtual cast of session 6 of Who Will Own the Forest. By the way, I think this is the only national level conference that still has a question in its name, and I think it should remain there for the near future. I'm here with Spencer Meyer, who I will introduce in a moment to discuss the future of timberland investing. We have subtitled this Climate Risk and Reward, Regulation, Responsibility, and the Reality of the Fiduciary Challenges in the Decades Ahead. Some of you might remember me as GMO's renewable resource partner until I disappeared into the ag world 8 years ago. Clearly, the ag world has taken its toll on me since I had a lot more hair 8 years ago. Now, let me introduce Spencer. I think the best way to kind of characterize Spencer and why he came to mind for me was because he's a very reasonable advocate in some sense on the other side of the equation, on the conservation, sustainability side of the timber equation, has a lot of operational experience. He has a PhD from University of Maine, as well as a degree in forestry from University of Maine. He's now the senior conservationist at the Highstead Foundation and the co-founder of the Sebago Clean Waters Initiative. He's very sympathetic to our fiduciary responsibility, and I think essentially we will begin our discussion by talking about that fiduciary responsibility, the changing definition of it, in the sense that the choice to spend money on something that doesn't directly benefit your investors, but indirectly benefits your investors. And maybe I'll begin my first question to Spencer by asking him, just describe that dynamic, these cooperative dynamics. Climate change in some sense is the largest cooperative endeavor mankind has ever faced. But on a minor level, your experience with dealing with the land managers of large scale timberland, Give us some insights on what it's like to be on the other side of the fence, in a sense.
Sure. Well, thanks for welcoming here, Bob, and conference organizers. It's really great to have this opportunity to speak to you and the rest of the participants in the conference here. I think I want to back up a bit and say the early part of my career was really where my operational experience came from. And that was working through the Cooperative Forestry Research Unit in Maine with a large timberland owners and investors that owned roughly half of Maine's woods. So we had a laboratory of around 8 million acres. We did silviculture trials, wildlife research, some biodiversity research. And I went there to graduate school in the first place to really understand the business model of forest owners and how any new activities, whether it's conservation or silviculture, really fits in with that business model. And so that was a really important education for me early on. And one of these collaborative notions that you're talking about is the fact that no matter if you're a conservation NGO, a state organization, or a timberland investment outfit, you have the same basic challenges if you own lots of land. And we're talking about landowners in the tens to hundreds of thousands of acres, with the biggest being around 1 million acres. And I found that really fascinating that you have these basic problems of road maintenance and timber management and environmental regulations and permitting. No matter what your outcome, what your objectives are as a landowner, you still face these same basic issues. At the same time that they have these different objectives, they're really addressing different value systems. So investors might be looking for the cash flows from the land. Public entities might be looking both for revenue generation, but also having a responsibility for some of these public values, such as climate change regulation, clean water and clean air, recreation, et cetera. And I think what we're here to talk about today is really how those two things are blending together over time. That the market is beginning to recognize these sort of broader suite of representative values coming from the forest. And in that spirit, I think we could make a friendly amendment to the name of the conference and say who will benefit from the forest. It's not just who will own the forest, but who's going to benefit from it. Because at the end of the day, it's whoever's benefiting from the forest that is likely to keep paying for goods and services coming from those forests. And I know we'll get a lot deeper into that.
The regulatory environment has finally sorted itself out so that appropriate lands are investable as mitigation banks without the massive risk of uncertainty. It seems to me, you're teasing us a little bit with the carbon discussion, so we might as well dive right into it. That carbon is sort of in that phase, maybe an accelerated phase relative to mitigation banks because it's a more important and bigger issue. Maybe speak to that just a little bit about where you see carbon regulatory structures, and ultimately we can talk about where those structures might lead the market.
I think, as you said, we're seeing an acceleration for other markets, partly because there has been this groundwork laid in wetland mitigation, for example. But something else we're seeing this time is not just regulatory-based carbon markets, but voluntary-based carbon markets. And so, we really start with the California Air Resources Board policy that really sets the stage for any carbon payments. Most of them, as far as foresters are concerned in the US, are coming from these improved forest management projects, which are essentially paying landowners to keep the forests they already have as forests, and therefore locking in the carbon for a 100-year period, for example. The voluntary market is not based on any underlying regulation, although some folks would say it's sort of pre-compliance, that is to say, anticipating having a policy liability down the road. But essentially, these voluntary agreements are more flexible, and the market is beginning to surpass the California market, at least for forest landowners. That has a lot to do with the fact that the voluntary agreements tend to be much shorter in duration, for say 40 years. They tend to be more flexible. There's a direct relationship earlier on in the process between the buyer, often a corporate sustainability program manager for a big US corporation, at least here in the States, and the landowner that can often meet in the middle and help each other's objectives.
I'm struck by how much effort it might take for the manager to extract these values. And it seems to me that in some sense, inertia might be really the enemy here, not necessarily the availability of a market to monetize these values.
What has happened over that time is this middle group within the industry has really developed the expertise that has been so difficult in the past. And so there have been organizations, many landowners among them, that have sort of paved the way, figure out how to do these improved forest management carbon deals. And now there's firms out there that do these routinely, left and right, both on the compliance side and on the voluntary side. One important element is that, and I want to talk a bit about the fact that the current carbon markets are really focused on paying for the carbon that we have now, the carbon that is on the stump, the carbon that is already stored in the trees. And certainly those trees are sequestering more carbon. But we need to get to negative emissions, and that has a lot more to do with growing additional trees. And we can talk a lot more about that.
I'm mindful that the name of this is the future of timber investing. So I am trying to imagine, if I am an investor looking to invest in timber today for the first time, how my questions might be different with respect to these topics than they would have been 10, 15, 20 years ago. So that's sort of a mishmash question, but really talking about futures, talking about it really starting from today, not from an ownership position that exists.
Where we need to get to as a country, and indeed a globe, is really this concept of negative emissions. That is not just conserving the carbon we have stored today, but sequestering much more carbon than we're able to right now. And so I think that provides a lot of opportunities for forestry if we can come up with this future carbon idea. So the premise here would be somewhere between futures contracts and wood supply agreements, where landowners would agree to supply carbon they have not yet grown to a corporation, voluntary, in this case, corporation, who is looking to offset more of their own emissions, not only today's emissions, but they know they will have future needs to offset their emissions in the future. Now, there's a lot of challenges with this problem, of course, is that the trees are not yet there on the ground. Nobody knows if you can verify future carbon you haven't yet grown. And so there are a lot of problems with this. But if we went back to the 70s, people would have said there were a lot of problems with wetland mitigation banks then as well. The benefit here is that you can incentivize landowners to change their harvest management. This is not to say they shouldn't be harvesting, but this is to reduce the emissions from the forest. Mind you, when you cut trees, there are inherently emissions, even if you store some of it back in products, as happens. And so you would sell discounted carbon future offsets today that you would agree to produce in the future, much like a wood supply agreement might produce. Now, there is not really a construct to do this yet, but as the world realizes the urgency of climate more and more, and of course, what's going on in California right now with the fires is front and center for virtually everyone, not just those suffering through it directly. And as other more frequent storms are happening in our part of the country, in the Northeast here, as this urgency increases, people will be looking for more and more solutions to reduce carbon emissions. And forests are one of the great ways to do that through the whole suite of so-called natural climate solution opportunities.
As you describe that, an investment idea kind of pops to mind, which is not novel. I'm sure many have thought of it before, but you start to look for those forests that can provide the greatest future carbon sequestration and therefore the greatest future carbon benefit. You enter into one of these contracts, which gives you, once you've purchased this forest, or probably congruent with purchasing the forest, you enter into one of these corporate contracts, which give you a steady, predictable stream of cash flow. And now you're outside of the volatility of chip and saw timber, pulpwood, and you don't have to, you can certainly augment your returns by managing for some timber products, but you've got this investment that has a predictable stream of cash flow, which seems to be, we've talked about this, something that's a little bit more appealing to the pension fund long term. And the pensions certainly, need that kind of a predictable cash stream.
Yeah, I think that's right. I mean, much like a wetland mitigation bank identifies properties that need to be mitigated, that have a problem and need to be improved, you might actually seek out forest land that otherwise would not be ideal for investing in from a timber market perspective, because it might take too long to go from degraded forest to a viable forest product. But now it makes degraded forest land more investable at a higher price. It incentivizes letting those forests recover essentially, and the carbon is paying for it. If you think about the investment thesis of buying heavily degraded land and sitting on it for 30 or 40 years to let a really heavily stocked forest come back, there's not a lot of opportunity to do that because, it just doesn't pay for itself because it takes so long. But if you had a steady stream of cash flow from these carbon payments that could essentially pay for that period of time, now you would have bought yourself the time for the forest to recover, and now you'd be left with a fully stocked forest from which you could continue to harvest forest products in a very sustainable fashion. Meanwhile, still spinning off all these other benefits that we know come from well-stocked, well-managed forests.
One of the issues I've run into in the past is, filling out these 50-page ESG questionnaires, having them go into the file for the investor, having the investor make the investment, and then very little concern about actually monitoring us, the investor monitoring the manager, given their responsibility for these ESG mandates, I guess, and representations that they've made. You and I have discussed a very interesting idea that you have, which is part of a reporting scheme. Just elaborate on that. I think that's a very important idea that might make it into the world in time.
I think the closer we can get the sustainability reporting to align with the financial reporting, the better and the more transparent this is going to be in the long run. If instead it continues to be separate sort of reports and the financial returns are really separate from the impact or sustainability returns, that probably won't have real impact in the long run. But we need to bring these two things together. And that means better understanding how things like climate risk impact our ability to realize returns we might have promised. And of course, we're just touching on the environmental sustainability, but there's a whole host of other social sustainability and equity issues that really need to be brought into that as well. There have been examples. We've all seen sort of corporate sustainability reports. Last I saw, something like 70% of big companies in the US are providing them now. But when you look through them, they sometimes feel a bit like window dressing. I've seen other examples where they feel very tangible and they are directly related, at least in the reporting, the outcomes on the investment side as with the sustainability side. And I think normalizing that need and that expectation from investors could really go a long way in making these tangible sustainability outcomes.
I think this will be a semi-controversial statement, but I think it also would have softened the blow of the negative return history of the last 10 or 12 years, where you would see that your investment might actually, when it's marked to market, have gone down slightly. But if you had a sustainable offset that showed that there was, additional carbon, all that chip and saw on the stump down there in the southeast is sequestering a lot of carbon. And if you had some kind of offset to that, so that and again, I'm stepping into the investor shoes, that when you go to your investment committee and they say, why is our timber investment down 5%? You say, well, the markets are lousy, housing hasn't bounced back, the whole song we've heard for a decade or more. But you could also say, but our sustainability record is actually, or bottom line, is quite substantial as we manage the forest to get the trees growing as fast as possible and get the carbon sequestering. I mean, just as an example.
Yeah, I guess the only thing I disagree a bit with there is that sets up them as inversely related. And I think that's not where we want to be, right? We want them to be moving simultaneously. And the more we can develop markets for some of these ecosystem benefits, the more closely they will be aligned. But your point is well taken. Even in bad years, this goes back to the optionality. Even in bad market years with price of lumber falling, you are still creating some benefit, sustainability benefit. The question is someone going to pay you for that sustainability benefit? If they're not, then it sets up this good news, bad news situation. But if they are, it sets up a win-win situation where both your finance outcomes and your sustainability outcomes are moving more or less in sync, maybe not linearly, but in sync. So I think that's the world we want to get to, where you can both make market returns. We could call them risk adjusted, or we could call them sustainability adjusted returns, while you're having these positive outcomes. And what better place to do that than in the forest sector, where the thing we know how to grow and manage have so many benefits for the public good. These things should be moving together, and I think that's the future world I'm excited about.
Well, you walked right into the verifying the statement of a manager who I spoke to or consulted as I was preparing for this, who said that once the ESG file is filed and it's in the due diligence component for an investor, it gives the investment manager not just the right, but the responsibility to find ways to not only be true to the ESG concerns, but also to enhance value. And that you're actually shirking your fiduciary responsibilities if you're not pursuing carbon, if you're not finding a way to turn that sustainable benefit into some type of a cash flow, and that you can justify making the effort by pointing to all the ESG stuff that you claimed and that they asked for. And I think that revolving door is just starting to evolve, where the manager actually can go to the investor and say, this is what we're doing because this is our responsibility because you told us it was our responsibility.
Yeah, I mean, I think that the notion of fiduciary responsibility, often sort of under this cloak of, money only, finance capital only, seems really outdated to me. Maybe that's a little naive, and I don't know all the history of the fiduciary law, but it seems to me that the construct of fiduciary really meaning, capital preservation, first and foremost, long predated our understanding of what the impacts our investments actually have in the world around us. I don't think, decades ago, we really understood, or at least we didn't broadly understand things like climate change and what the detrimental effects of that are. We didn't understand sort of extractive degradation of community, social, and economic structures, for example. But now we understand those things pretty well. And sooner or later, our understanding of fiduciary responsibility is going to evolve to think about not just sort of the financial capital, but this whole concept of natural and social capital. The dollar value is really just one of the capitals that we have. And if we're not preserving our social and natural capital at the same time, that jeopardizes our ability to, get returns on our financial capital in the future. So, I know that's a bit wide-eyed vision of the future, but I think the way to do that is to make it so that these managers are actually generating increased cash flows because someone is paying them for those things. And then it does bring the fiduciary finance side with the fiduciary with the social and natural capital.
We're talking to a very powerful group right now who control millions and millions of acres of timberland. And they have a lot of power to really transform the environment, albeit by increments. But there needs to be sort of to me, it seems there needs to be sort of a psychological shift to get a more communal feel that it is one's responsibility as an individual decision maker to be doing things that benefit this global problem. What do you see as the key, I guess, psychological, philosophical shift that needs to happen across the board?
Sure. Well, I think sometimes I kind of go back to this central tenet of forestry and growing up as a forester is really this notion of managing a forest for flexible options down the road. And I think we need to be doing that broadly with our natural resources because we frankly have no idea what we're going to expect from our forest in 20 or 50 or 100 years from now. Right now, we think it's all about carbon. We know it's a lot about timber products. We're beginning to understand how it's about air quality and water quality. But, foresters' basic job at its core is to make sure they're managing for flexibility down the road, whether that's for different product markets or whether it's going to be for different values society needs from the forest. And so I think we, as investors, need to be doing that as well, as we are generating returns from our assets, whether they're farms or forest lands or anything else. Sure, we need to make our hurdles, but at the same time, we have to understand what are we leaving behind. And so there are the values, judgment-based reasons to do that, which will only speak to certain people. And we're seeing a lot of those now. A lot of large foundations and institutions are beginning to invest that way. But we also need to make the business case for doing it, because history has shown we don't tend to do these things on our own if we're not forced to. And if things get bad enough in terms of our environmental conditions, regulations will eventually crop up. But there are alternatives where sort of business incentives and some regulatory underpinnings can work together to compel us to be investing in these things. Like we talked about the wetland mitigation banks. That took a really long time, and it has changed the way business occurs in many cases. So I would love to see more investment in pilots and innovations, R&D, if you will, in this conservation finance concept, where we're trying to understand what kinds of future carbon payments might make sense for investors and for the landowners. What sorts of clean air and water investments might make sense? Because if we don't invest in the R&D of understanding how to develop these markets, or if we just leave them to scientists, or if we just leave them to government agencies, we probably won't produce viable markets that are resilient over time. And so I'd love to see landowners and investors working more closely to actually be proactive about developing these markets. And of course, we see that a fair amount. Natural Resource Conservation Service does this through some of their programs. The U.S. Forest Service is beginning to do this as well, really working on sort of these pilot opportunities. I think the Forest Resilience Bond that was launched a couple of years ago in California, where the basic premise is, can you raise some capital to invest in improving forests or reducing fire risk, for example, because the landowners will have fewer costs in the future for both putting out fires and remediation of fires, not to mention the pollution of runoff after fires.
So returning to the title of our session, which is about the future of timberland investing, I want to wrap this up with some of your thoughts about how we bridge this gap between the human tendency to ignore giant problems and not look far into the future. And especially when you have a problem that's as big as climate change, it's something to, one might feel that it's not their responsibility, if you will, to do a whole lot about it of maybe turning off the lights in your house and, protesting against coal or doing something that's relatively obvious, but not taking personal chances or responsibility for the problem. Do you have thoughts on how that gap will be bridged over the next couple of decades, and how, and this is the hard part of the question, how timberland investment world might change its focus as these decades unroll?
Sure. Thanks for that question. I mean, I think at the end of the day, the timberland managers are going to do what the investors call for. And we've already seen some inroads into investor pressure, whether it's on corporations or on private investments, to change their behavior. Now, we certainly have a long way to go, but there is precedent for that change to begin to happen. And I think an important part of this is that as the holders of the capital shift over to younger generations, both within families, but also within management positions of large investor groups, I think we're going to see this more focus on sustainable and long-term benefits from the investments come together. Now, just one quick example is I'm part of this network called the Confluence Philanthropy Network of Impact Investors and Family Offices. And recently at a conference, we did a role playing. This was back when we could get together in person. We did this role playing exercise where you were an investment manager pitching ideas to family investment committees. And we did it in a couple different ways. The first way was you did it with the older generation. We pretended they were sort of old gray-haired investment committees with maybe a fairly typical conservative approach to the investments. And then we did it again where you met with committees that had part of the younger generation on the investment committee. And what we found as we did this in small groups was there's a really different approach you take if you have partners on the other side of the table who understand some of these important long-term sustainability, environmental and social needs of our investments. And it's a really different prospect if you're trying to convince someone based on the values judgment alone, or if you're trying to convince someone on part on the values judgment and part on the business case for doing these. And so everything we talked about earlier about the fiduciary responsibility needing to evolve into the future to be more broadly about not just finance capital, but human and social and environmental capital as well, I believe is where this is going to go. The last thing I'll say about that is I think that as we develop more opportunities for asset managers to generate cash flows from things like carbon payments or water quality payments or others we haven't even thought of yet, the easier it is going to be to link the value case with the business case.
Spencer, thank you very much for that. That was a great summation. I agree. I think that the merging of values in business, especially if the markets start to cooperate, whether it's carbon or whether it's habitat values, et cetera, I think that's a great direction and trend that we will see. Again, thank you to the organizers of this. It's been an honor and a pleasure to participate. And Spencer, thank you very much for your time.
Well, Bob, thank you for all the good questions and the partnership on this. I'm looking forward to keep batting around some of these ideas with you and also looking forward to the questions that the participants will have in the upcoming Q&A. So thanks again, Bob, to you and to the conference organizers.
So welcome to our live portion of the question and answer of this presentation. And Spencer and I have been sitting here for the last 5 weeks in the same clothes, making sure that we had consistency from the presentation to the live Q&A. A bunch of very interesting questions have come in. Many are quite provocative, some a little bit political, and I'll see if I can kind of calm that down slightly. The first question, Spencer, is in terms of values per acre as we move toward carbon and habitat credits, are you able to make an estimate of how those values on a dollar basis might move over time?
Yeah, that's a great question. Usually the first question people want to know. And I guess I'll give a couple of numbers, but the thing to remember is that a lot of what we talked about earlier is how things could be down the road, not necessarily the existing markets. And I realize people are interested in the existing markets. So, the price per ton for offsets range considerably, somewhere in the $8 to $13 an offset these days, depending upon voluntary or compliance markets. And the forest growth varies dramatically by silviculture, of course, but even more so by region, by starting condition. So it really varies a lot. There are data out there. We could certainly follow up and give some more concrete examples. But on average, you could think about maybe a ton per acre per year. It would be, at least in the Northeast, would be a reasonable growth estimate. But remember, you're getting paid for the carbon you have above the common baseline, and that's calculated in different ways for different systems. But essentially, you're getting paid for the additionality, not necessarily for how much you have the capability to grow in the future, which is getting to my point about these carbon futures ideas.
A couple of questions that I'll kind of merge together about the idea of new trees, and that you mentioned to get to kind of a carbon negative world, we need to plant more trees. And the questions really are about incentives to do that, and also about the reality of the sequestration new trees and how that's calculated, because young trees are sequestering very little carbon. It's the intermediate level trees that are growing fastest that are probably sequestering the most carbon. If you have an idea of maybe a regulatory or an incentive structure that might help advance that.
Yeah, an important point is to separate sort of market opportunity, which is doing one thing, from what might have the biggest climate benefit down the road. And those are really not necessarily the same thing. And I think there's this longstanding debate about young trees versus old trees. And, younger and middle-aged trees are sequestering carbon faster, but they're not storing as much, and they may not actually be, because they may get harvested, you may actually have additional emissions from that. So if you have to separate out the tree level analysis from the stand level analysis. So that's one thing. The other is that the carbon markets right now are paying forest landowners who already have that carbon on the ground. So they, in effect, are already doing something above and beyond maybe their neighbors in their region. And as I said, it's compared to a common baseline. And so you're getting paid for what you have already accomplished. And there's additionality there relative to other landowners in your region, but there is not necessarily additionality beyond what you as an individual landowner might often do otherwise. And so sometimes you can read quotes in articles about newspapers where a landowner or farmer might say they're getting paid to do basically the same thing they're already doing. And that is largely true. That is the current market, and people are taking advantage of it. But I think of the current carbon markets as really a transitional period. At some point, if you want to truly be doing negative carbon emissions, we need to be paying for practices that sequester additional carbon above what any one person or landowner would be doing anyway. And so one of those opportunities is to look at degraded lands and pay landowners for agreeing to use those degraded lands to restore and to recover to fully stocked stands. After which, then there are also plenty of timber products to be harvested in some more stocked but sustainable basis in the future.
Maybe just a personal comment here that as someone who's spent the last 30 years on their hands and knees planting trees on degraded lands, one of the challenges there is finding the right species to match the degraded land and something that'll thrive and grow. And I think there's work being done out there, but I think that's probably a hole in the donut right now. This is I think, a complicated question, which will lead maybe to the final question that I've got here. What do you think the impact of the Department of Labor's two proposals to regulate ERISA, retirement plan? These are the two proposals, and as follows: retirement plans cannot consider non-financial factors for retirement plans. That would kind of derail a lot of what our discussion was about, I think, if that were implemented. And proxy voting on corporation ESG proposals cannot be made, I'm assuming, in a positive way unless there's a clear economic and financial benefit to the retirement plan. So this essentially tightens the fiduciary definition to really be purely financial and not necessarily social, environmental. And your thoughts on that?
Sure. Yeah, I don't know all the details, and I haven't followed it really closely. But what I do know, what I have followed, is that there seems to have been overwhelming opposition to these proposals, and that opposition, and during the public comment period, I think is largely being ignored, is my understanding currently. The whole world is going to change in one of two directions in about a week, and this very well could be one of those things. A previous administration went pretty far to include the concept of natural capitals into federal evaluations for federal land-based projects. You had to actually include the natural capital or an assessment of it. So it was not just a sort of financial capitals approach. We all talk about ecosystem services. Essentially, federal agencies were then, sort of commanded to include assessments of those. What you're talking about is a Department of Labor proposal that forces investors to go the opposite direction. It seems like the market of Fortune 500 companies that want to report on these things and want to consider these things is going the opposite direction. Mm-hmm. So we might have yet another example of the markets and the business community going in a different direction than the political agenda as of today. That could look pretty different in a week or three.
Yeah, that I'm going to save my last question here, which relates to that. But there are a couple questions on additionality, and I'll see if I can consolidate them. One of them asks, as more and more carbon credits are sold, the common baseline will increase, making additionality more and more difficult to achieve. How do you see that impacting carbon supply and price?
That's a really great question. One I don't actually hear very often, but I think is an important one. Um, on the demand side for these credits, the cap and trade system, the way it works, in California at least, is that the cap is being lowered on a predictable basis, and so the need for polluters in California, in this case, to offset their emissions or to reduce them goes up over time. Although because of policy changes a couple of years ago, they're actually allowed to offset a smaller proportion of their overall emissions than they used to be. It basically was halved. And at the same time, the geography was constrained. So it used to be the credits could come from anywhere, and they still can, but a much lower percentage of those offsets can come from outside the state of California. So that's on sort of the demand for the credit side. I think this question is getting at the supply of that. If all the landowners in a particular region signed up for this and they all reduced their harvest so they could get paid for more carbon, now the regional baseline goes up. And in theory, I think that is true. Whether that's actually happened, whether there's been enough uptake in offsets in any one region, I guess I wouldn't expect that, although I don't know for sure. But again, I go back to my comment earlier that this type of cap and trade approach to carbon, I think, is really just a transitional period that's going to bring us to some new equilibrium. And then down the road, once we realize and have the political will that carbon is even more important than we thought, and that is, one indicator of that is the academic and other estimates of the social cost of carbon keep going up. Every time a new study comes out, that number seems to go up. And so whatever future carbon offsetting or taxing system we have that forest landowners can take advantage of, this particular question, I don't think is going to be a big of a deal once we get past this transitional period.
I'm going to close with one last question, which just came in, and it's a little friendlier than the the question that begins with. I'll just give you the beginning of the questions, and so the political question, which says, since it's clear that our country has been run by Tony Soprano for the last 4 years, what would you suggest a new administration do to advance some of the issues we talked about? I'm not going to let you answer that because that's, I think, out of bounds for now. The last question that I'll ask, and then we'll turn this over to the rest of the chat rooms here. The supply-demand tension. This is a very real issue I can see is going through everybody's mind between forest landowners and forest manufacturers. Factor into quantifying an investment decision. As a forest manager, I need a mill to buy my logs, which also actively provides economic vitality for rural communities. In a supply-constrained period, adding another competitive option is threatening to my manufacturing partners. Thoughts on how to address that concern? Also interested in your thoughts about economic impacts to rural communities to change to active forest management activities.
Yeah, those are really good questions. And I think it would be great if any of the large landowners represented here at the conference had some information to share at some point in the future about how much reduction, those that have done carbon offsets, how much reduction in actual forest products produced on a volume basis, let's say, has occurred. And I guess I'm not convinced that there's been much reduction in it, because often in the carbon projects I've seen evaluated, there's enough delta between what a landowner might otherwise be harvesting anyway and how much growth is accruing in any given year, that it's often that delta that's being sold. They're not completely constraining their ability to harvest products. Whether they are using the optionality to reduce the amount of their acreage they can harvest or not, it'd be really interesting to see some real data on that. again, I still think this is a transitional kind of approach that we have now, this current market, but it's an important question. On the rural economic side of it, I think we've done a lot of work with our team on looking at the importance of working lands as well as conserved lands in rural economies. And sometimes that is timber products and sometimes that is recreation. Usually it's a combination of those two things. And so I think as we see other value streams come into forest landers, whether it's carbon offsets or recreation or water quality payments or something else, we need to figure out how that is going to support the local community. Carbon offsets still require foresters. Now, they're not overseeing logging jobs and there aren't loggers in them, but it's not that there's no work. You don't suddenly have to stop. You don't get to stop managing your forest when you sell carbon projects. So I think that is a real good question that there probably is not a lot of information about yet, but I think we need to learn more about that.
It is interesting the way that dovetails with that other interesting question about the ERISA regulations, because part of ESG is the governance issue, the social issue, and the advancement of rural communities is a very important, difficult issue to solve, and wood products are part of that solution. And so if you take those ERISA regulations at face value, they're deleterious to that cause, which is somewhat ironic in this current rural-urban divide that we exist within right now. I think we've run out of time, which is unfortunate because there are some other great questions coming in, which maybe we can address in some of our sidebars here. I really want to thank the World Forestry Center for organizing these last 6 sessions. I have learned more than I've ever learned from a series of presentations. I think they've really advanced the cause of the World Forestry Center and this conference through a virtual medium, which is certainly not easy. So I'm very impressed and thankful and appreciate everything that's going on behind the scenes. And Joe, you're doing an awesome job. Spencer, thank you very much for this partnership, and I look forward to future conversations.
Yeah, Bob, this has been a lot of fun. I also want to thank the World Forestry Center for the remarkable job they've done recreating the content and the conversations that we otherwise would have had in person. There's plenty we missed out on, but from a content perspective, it's sure been a lot of fun. So thanks a lot, Bob.
Thank you.
That was a great conversation. But today's not over yet. Please visit worldforestry.org/breakouts to join one of our live breakout sessions, where you can engage with speakers and other attendees on a variety of Timberland topics. We hope you've enjoyed Who Owned the Forest, the Series 2020. Putting this event together didn't happen easily, so I want to take a moment to thank all the World Forestry Center staff and the advisory committee who did more with less to put this together. I also want to thank our sponsors for standing behind this organization and this conference. And finally, I want to thank you, the audience, who make it all worth it. We hope to see you in person at next year's Who Owned the Forest in September 2021. In the interim, stay tuned for more virtual content from World Forestry Center. Now, follow the link below to access the breakout sessions.